Welcome to our channel where we decode the world of finance for you. Today, we're peeling back the layers of behavioral finance, a fascinating field that explores how psychology influences our decisions in stocks and crypto. It's an essential perspective, but remember, we're here to inform, not advise. The content we share is not financial advice, but rather an exploration of complex financial phenomena. Ready to dive into the fascinating world of behavioral finance? Let's get started. Behavioral finance, in simple terms, is a field that combines psychology and economics. It's a fascinating area of study that goes beyond the cold hard numbers and delves into the human element of financial decision-making. Traditional finance theories often assume that people are rational, that they always aim to maximize their wealth. But let's face it, we're humans, not robots. We're driven by emotions, biases, and sometimes we make decisions that aren't exactly in our best financial interest. Behavioral finance seeks to understand these irrational decisions. It looks at the psychological factors that influence the financial behaviors of individuals and markets. It's like having a magnifying glass that lets you examine the quirks and intricacies of human behavior in the financial world. Understanding behavioral finance can give us unique insights into investor behavior in the stock and crypto markets. It's like cracking the code to human nature, at least when it comes to money matters. There are several key concepts in behavioral finance that help explain investor behavior. Let's dive into some of these. First up, we have loss aversion. This is the idea that people feel the pain of loss more acutely than the pleasure of gain. For example, if you invest in a stock and it starts to dip, you might hold on longer than you should, hoping it'll bounce back. That's loss aversion at play, and it can lead to some risky decision-making. Next, we have mental accounting. This is when people separate their money into different accounts based on a variety of subjective criteria, like the source of the money or the intended use for the funds. Let's say you receive a bonus at work. You might be more inclined to splurge it on a luxury item, treating it as extra money, whereas you would never consider spending your regular salary in the same way. That's mental accounting. Then there's herd behavior. This is the tendency for individuals to mimic the actions of a larger group. In the world of investing, this can mean buying into a hot stock or cryptocurrency because everyone else is doing it, even if the fundamentals don't support the hype. Herd behavior can create bubbles and crashes, and it's something savvy investors try to avoid. Lastly, we have overconfidence. This is a bias where an individual overestimates their own abilities or the precision of their information. For instance, a trader might believe they can consistently beat the market because they've had a few wins, disregarding the role of luck or market conditions in their success. Overconfidence can lead to excessive trading and risk-taking, which can erode investment returns over time. These concepts offer a glimpse into the psychological factors that influence investment decisions. Understanding these behaviors can help us make more informed choices and potentially avoid some common investing pitfalls. Now, how does behavioral finance apply to stocks and crypto? Let's delve into this fascinating intersection. Behavioral finance, as we've learned, is all about the psychological factors that influence our financial decisions. Now, imagine these factors at play in the dynamic and sometimes unpredictable markets of stocks and crypto. In the stock market, investors often fall prey to a bias known as the confirmation bias. This is where they seek out information that supports their existing beliefs and ignore data that challenges them. For instance, if an investor is bullish on a certain stock, they might overlook negative news about the company and only focus on the positive, leading to potentially poor investment decisions. Similarly, in the crypto market, a common behavioral pitfall is the fear of missing out, or FOMO. As the value of a cryptocurrency soars, investors might hastily jump on the bandwagon, fearing they'll miss out on potential profits. However, this can often lead to buying at the peak and facing significant losses when the market corrects itself. Emotions, therefore, play a significant role in both these markets. The thrill of a rising stock or the anxiety of a falling crypto can often cloud our judgment. This is why it's crucial to be aware of these biases and not let emotions dictate our investment strategy. One way to mitigate these biases is by adopting a systematic approach to investing. This could mean setting predetermined rules for when to buy or sell, or diversifying your portfolio to spread risk. It's also helpful to constantly educate yourself about market trends and stay informed about your investments. Remember, the goal isn't to completely eliminate emotions from investing. That's nearly impossible. Instead, the aim is to recognize these biases and make more informed, rational decisions. In the volatile world of stocks and crypto, understanding our biases can help us make better investment decisions. Emotions are an integral part of the investment journey, but by acknowledging their impact, we can navigate these markets with a clearer mind and a more strategic approach. Let's recap what we've learned about behavioral finance and its relevance to stocks and crypto. We started off defining behavioral finance, which is a field of study that combines psychology and economics to explain why and how investors make their financial decisions. It's all about understanding that our decisions are influenced by cognitive biases and emotions, which can sometimes lead us astray from rational decision-making. We then delved into some key concepts of behavioral finance. We talked about the concept of herd mentality, where investors follow what others are doing rather than making independent decisions. We also discussed overconfidence bias, which can lead investors to believe they have superior knowledge and can thus outperform the market. Next, we applied these principles to the world of stocks and crypto investments. We saw how these psychological factors can significantly impact the way we invest in these platforms. For instance, the fear of missing out, or FOMO, can drive us to jump into a booming market without careful consideration. Behavioral finance is not just about understanding the markets, but also about understanding ourselves. It's about recognizing our biases and emotions, and learning to make more informed and rational decisions. Thanks for watching, and remember, understanding your behavior can be the key to your success in finance. Be sure to like, comment, and subscribe, and hit the bell notification so you'll get updates anytime we upload a new video.